has proposed some changes to the qualification rules for veterans' pensions. The most popular of these pensions for our purposes is called aid and attendance. It is used for our older clients who are in need of long-term care, either at home or perhaps in a facility. For those veterans who qualify for the pension, it can be up to $2,150 per month. That can go a long way to help defraying the cost of care at home or perhaps in an assisted living facility. Now, there are resource and income qualification rules for aid and attendance. In January of this year, the VA proposed changing some of those rules. If they become law, it will make qualification for these pensions much more difficult for our clients. Here are 3 big changes to these rules. First, the VA is going to define net worth when qualifying for the pension. In the past, the amount a spouse or a couple could keep while qualifying for the pension was rather unclear. We often felt it was $80,000, but in some cases they told us it included a year's worth of income of the veteran. And then in some cases they told us it was dependent on how old the veteran was. You never really could get a clear answer from the VA. So what the VA is proposing with these new rules is that net worth is essentially going to track the Medicaid long-term care rules associated with resource allowances for couples. So if you have a couple that has $100,000, they cut that number in half, and that's your resource allowance for Medicaid purposes. Unlike Medicaid, the VA will add the veteran's annual income to this total. Now, the resources used to calculate the net worth for veterans' pensions will essentially track the Medicaid rules. For example, the house will still be considered an exempt resource. The second change is closely related to the calculation of net worth. The VA will allow out-of-pocket medical expenses to be deducted from income when calculating net worth. This will allow veterans with higher income to qualify for the pension. One of the problems seen with the proposed regs is they're not as clear as they should be. From what we're reading, some of the proposal doesn't cover all of the payments to assisted living facilities. I'm sure that will be worked out in the negotiations as the legislation gets to Congress. Now, the big change in the regs will be the creation of a transfer of asset penalty. There will be a 36-month look-back for transfer of assets. And there will be a penalty levied for a transfer of assets during that look-back period that reduces the veteran's net worth. So not all the assets are subject to the penalty, only those that reduce the net worth. The VA calls these covered assets, and the penalty is going to start on the month following the date that you made the transfer. So the rule is like the old Medicaid rules. Okay? When calculating the penalty, they are going to use a divisor equal to the maximum monthly pension rate, and the penalty can be no longer than 10 years. Prior efforts to pass similar legislation have failed in Congress. However, the VA is clearly not giving up, so it's probably just going to be a matter of time before these changes become part of the pension program.